Hi, everyone, and welcome to AIADA's AutoTalk. I'm your host, Rachel Soleimani. For any new listeners, anyone who has registered for today's program will be receiving a copy by early next week. Today, in a time where we need him the most, we welcome back our good friend, Cox senior economist, Charlie Chesbrough. Charlie, I know you have a lot to get to today, and I say that every single time you're on anymore, but especially today. So I'm going to let you take it away.
All right. Well, thank you so much. And we're going to give you the outlook for the vehicle market. And I have to say, it's a very difficult time to try and be a forecaster in the automotive industry, as I'm sure you're well aware. It's a very fluid situation regarding what tariffs are going to be in place and when and what. But it's changing by the moment. I think we even had an announcement even today about Mexican tariffs. But we'll talk a bit about it and what it's going to mean for the industry. And we're going to go through our usual chapters here. We're going to start by doing the economic and automotive outlook. And then I want to talk a bit about what's the vehicle market conditions as it stands today, because frankly, things are looking pretty good out there. And then I'm going to talk a bit about the alternatives and battery electrics and plug-ins and how they may be at risk as the next policy that President Trump implements may be tearing up the battery electric and the Inflation Reduction Act and that $7,500 credit. So we'll talk about that and what it might mean for the industry, and it's not good news. But let's start by talking about consumer sentiment. And I've shown this chart many times to this audience, and this is from the University of Michigan, and it really gives us, I think, the best look at where we are as a country with the longest history. And this data goes back over, about 50 years worth of data. And you can see where we are today on the far right. That's where we are, where consumer confidence has fallen quite a bit over the last 2 months. We've been on an upward trajectory since hitting an all-time low in June of 2022. That's when gasoline hit $5 a gallon across the country, and inflation was running at about 9%. And people were freaking out in this country about all that inflation. Well, consumer confidence has been improving, but we've fallen quite a bit in the last couple of months. And it's really sort of a post-election shock because there was some talk that maybe there was some enthusiasm after the election. But that started to change as we're seeing movement under who is optimistic out there and who isn't. And the University of Michigan also puts out their consumer sentiment by political affiliation. And you can see here on the far right that the election happened in November, and October was our last data point before the election. And you can see that blue folks, or the left-leaning part of America, is in significant decline in wake of the election. Versus folks who lean right, or red state Americans, you can see that they rose dramatically in the wake of the election. And then in purple, we have the independents. Those are folks who identify right in the middle. And the key data point you can see is here, it's very normal for people to automatically change their view on the economy. Instead of things being great, all of a sudden they see things as terrible, or the glass is half full as opposed to being half empty. So it's very normal that we see this kind of change as we can look back in history after elections. We do see people's perceptions change dramatically. But what's really kind of interesting here is that it stopped changing, at least in terms of the growth side from red state Americans. You can see that after a big surge, it's essentially stalled, and they too are not seeing upward gains anymore. And the independents are starting to see things more pessimistically. And so there's this general feeling out there that things are starting to turn, but they haven't really hit just yet. But one of the biggest things that's changed out there is inflation expectations. This is also from the University of Michigan, and they ask people, what are your expectations for inflation over the next year? And you can see that the recent data points are showing this really starting to spike, and this is just in the wake of the election. And it's really as a reaction to President Trump's talk about tariffs. So I really just wanted to kind of start about the impact of just talking about tariffs is having on the marketplace. And we can see that it's really having an impact on consumer confidence. And that's not good because we need confident consumers because they're the ones who are willing to take out a $50,000 car loan and go out and buy a new vehicle. So we've got Trump tariffs. And I don't really know what to say about this. It's really the unthinkable is now the reality. I guess the question we have to ask ourselves is for how long? The president has postponed tariffs now until April 2nd. We're talking really across the board impact to the automotive industry with Canada and Mexico imports of 25% tariff, reciprocal tariffs of up to 25%. Essentially, the president announced he's just going to do 25% on all imported vehicles. And that's on top of already steel and aluminum imports. He's got a 25% tariff on those, which is going to go into effect next week. And then he's also got China imports. Initially, a 10% tariff was implemented, and he just announced another 10%. So we're up to 20% on China imports. All of this is going to have a very dramatic impact on vehicle price. If there's all kinds of estimates out there, but if we had to guesstimate, what I've seen so far suggests that the steel and aluminum impacts are probably going to be in the neighborhood of $300 to $500 per vehicle. And that's just for the cost of aluminum that goes into a lot of vehicle parts, and then offshore steel. All of that is going to add quite a bit of cost to the vehicle. When we get to the countrywide tariffs, well, the analysis on that suggests the prices are going to go up for U.S. made vehicles about $3,000, and then for any vehicles coming from Canada, Mexico, or offshore, it's going to be substantially more. Now, the outlook for this, or what's kind of been said as how this is going to lay out, is it's going to have huge production disruptions if and when this is implemented. And the president has kicked the can down to April 2nd. Now, whether he's serious about it and how long would these tariffs be implemented for, and whether he would implement them and pull them back, it's really anybody's guess. But I would suggest to you that at this point, I think you got to plan for the worst and hope for the best, and figure that the president is serious about going forward with these on April 2nd. Now, S&P Global, they did an analysis, and they estimate about almost 64,000 vehicles are produced daily in North America, with close to over 20,000 coming from Canada and Mexico. And they suggest that if full-blown 25% tariffs went in just on NAFTA or USMCA, that could disrupt up to $20,000 vehicles of production within 1 week. And that would be just daily production could start to be impacted. Almost a third of all of the production here in North America could be impacted. And that's because we're going to see gridlock at the borders as products are trying to get over the border. We're going to see supply disruptions along the supply chain as suppliers are dealing with all kinds of structural issues and tariff issues and financial issues. The impact of all this, if the tariffs are just in place for a short period of time, it probably wouldn't have that much of an impact. But certainly, I think we can expect that at this point, the manufacturers are building inventories. We know that were relatively high post-Christmas, but they've come down a little bit. They're probably rebuilding those inventories, and we're going to talk about that in just a moment. And particularly from Japan and Korea and Europe, they're probably importing as many as they can. And I think we can also expect that they're going to pull back on incentives and promotions. There's probably going to be less pressure to move the metal today because the existing inventory we have is going to be a little bit more valuable than it was before because it's already here and therefore is tariff-free. The exposure to these tariffs for the different manufacturers is quite varied out there. This is looking at total production from each of the manufacturers and what share comes from each country of sales in North America. And you can see that only Rivian and Tesla are essentially 100% USA made. Their final vehicle assembly is in the US, so they wouldn't be looking at a massive final assembly 25% tariff, but they've got parts coming from all over the world too. So the parts under their hoods are certainly looking at higher prices. Among the other manufacturers, you can see that Ford and Honda and GM appear to have a little bit less exposure to the tariffs because they have a bigger footprint in the United States. But beyond that, everybody's going to be impacted by this. No matter where they're producing, these tariffs are going to go up and are going to have an impact on vehicle prices. So that's where we are today. From that, though, it's quite clear that the overall economy going into all of this tariff threat is actually looking quite strong. And the biggest, one of the biggest issues out there, of course, is inflation, and that was public enemy for a long time, but it's improved substantially. And this chart is showing the consumer price index, again, going back about 60 years of data, and you can see where we are on the far right. The most recent data point has inflation running at about 3%. It's still a little bit above the 2% target, but as you can see, it has been trending lower, but this last little bit has been sticky, particularly because of housing costs and rental costs. Those still are keeping inflation relatively elevated. But it has been moving in the right direction, and certainly inflation is not the crisis that it was just a few short years ago. The unemployment rate, the other important measure we can see out there, that's looking very, very strong. The most recent data point that we had from January had unemployment at just 4%. And it's essentially been 4%, give or take a little bit, for the last year. We're well below the normal 6% unemployment rate that we had during the 2000s. So the employment market out there still is looking quite robust. So we got inflation improving, the unemployment market's looking quite strong. And we look at something more immediate, job creation. This is a chart that's looking at the monthly job creation, and it too still looks quite strong. The most recent data points I have are from January on this, but we produced almost 150,000 jobs. We've been averaging close to 250,000 over the last 3 months. But that was then. There is some concern now that we may start to see this particular number start to fall, and that's tomorrow. We're going to get February's job numbers, and some of the early data points this week are showing that unemployment is down quite a bit. That unemployment started to rise quite a bit. That many of the layoffs from DOGE are starting to have an impact. Those government layoffs. And so we may see that this number right here is starting to make a turn, and that all of this talk about tariffs may actually be starting to lead the economy into a bit of a slowdown. And just looking at recent GDP news, and if you remember the old economic textbooks, it's C plus I plus G plus X minus M, or consumer spending, investment, government spending, and then trade. That's what goes into real GDP. And some of the recent numbers are suggesting that it's not going well. We've seen a surge in imports as many manufacturers are trying to get their products to the U.S. market before tariffs go in place. We've seen a big drop in consumer confidence, as I showed you on that first slide. We have to believe that business investment at this point in time is basically frozen. Without knowing what the rules to the game are going forward, it seems very likely that a big section of business investment has just been put on hold. And as I mentioned, the Department of Government Efficiency layoffs are going to have an impact, and spending from the government is going to be down. And one of the indicators out there, the Atlanta Fed, has an index that they call the Recession Monitoring Index, and it's showing a downturn at this point. So the news right now is quite positive up until sort of the last week, where we're starting to get some early indications that maybe things are starting to slow down there. But as I said, if we can avoid these tariffs, things are still looking quite strong out there. And one of the things we look at, of course, is average loan rates. And this is a chart that's looking at interest rates across the economy. That dotted line there is the federal funds rate. That's the rate that the Federal Reserve is able to raise and lower to try and control interest rates in the economy. And as you can see, it's been falling over the last few quarters, although they haven't had a drop recently. And the talk is that March isn't going to have a drop either. And there is concern that there was more cuts that were expected in rates throughout the course of this year. But all of this inflationary talk may force the Fed to actually pause additional rate cuts. So that's one of the things that we're watching. But the other interesting thing is that even though the Fed has been lowering the federal funds rate, you can see that auto rates for the new and used loans, they're in orange and green, they haven't been falling. They actually have been rising a little bit over the last couple of months. And that's really reflecting this view in the marketplace that there is this potential of long-term inflation. And so the willingness to offer longer term loans to the auto industry has dissipated a little bit. So the loans have gone up a little bit. But on the whole, we're expecting to see these rates start to come down as we see a more stable environment. And one of the other positive signals we see out there is that credit availability is starting to improve. This is data that's showing survey results from the Federal Reserve, from their senior loan officer study. And they talk to loan officers at banks all around the country, and they ask them, is your bank tightening standards on your loans? In particular, your auto loans. Are you tightening standards on your commercial and industrial loans for medium and large and small firms? And the survey is capturing what percentage of banks are saying, yes, we're tightening standards. And you can see that the recent data points are showing that it's coming down substantially, that we had the big COVID spike where banks said, we're going to tighten our standards significantly. Then they came down. Then we saw interest rates start to rise. So the banks responded by tightening their own lending standards. But now it's coming down. And we can see that in green there, that lending to automotive loans is actually improving dramatically out there from where we were just a few quarters ago. So that creates an environment that we think that there's going to be growth potential from the lending sector to be a little bit more aggressive in how they're lending to the vehicle market. And that can be very helpful because looking at what's happening in the vehicle market today, we can see that it's really led by purchases by the most affluent folks in our economy. This is a chart that's showing the share of the new vehicle market by FICO score. And in green, you can see what the share of the market that's got a FICO score of 720 and above, and how that rose dramatically during the early COVID days, and it's remained elevated over the last couple of years. And where we saw a big decline is in the subprime sector, that red line, which is the share of the market with FICO scores ranging from anywhere to 620 FICO score. It fell dramatically during the days after COVID. And it started to recover a little bit, but it still remains relatively low. If we have more aggressive lending out there, that more credit is being made available, this is where I think we're going to see our biggest growth opportunity, that we're going to see more buying from the lower FICO score shoppers out there, because lending may be a little bit more available to them now than it was just even a year ago. So all of that suggests things are moving in the right direction. But we're still facing massive headwinds, and that's monthly payments. We're seeing that this is a chart that's showing the average monthly payment for new loans, new leases, as well as used loans. And you can see that average monthly payments aren't rising like they were just a few years ago, but they still remain quite elevated. And if we look at where average loan payments are today compared to 5 years ago, we can see that new monthly payment, $781, that's 26% higher than it was just 5 years ago. A used loan, $563, that's 30% higher. Leasing is not up quite as much, only up 17%. But you can see all of this is making these monthly payments unaffordable for many, many households out there. And that's the biggest headwind that the vehicle market is facing right now. So what does all this mean for the vehicle outlook for 2025? Well, your guess is as good as mine at this point. I'm telling you, it's very, very challenging to try and forecast in this type of environment. But what we are seeing is that it does appear that the Trump bump that we had in the fourth quarter is likely over. This is a chart that's showing the monthly light vehicle sales SAR, or what the selling pace is on a monthly basis. And you can see that we've had a nice recovery in the sales pace out there since September of 2021, when we had sort of the leanest inventory period. But we're down from the 16.8 vehicle SAR that we had back in December and a 16.6 that we had in November. The vehicle market was really humming late in the fourth quarter, but it's come down substantially. But the latest data point we got from February earlier this week does show us back at a 16 million level. That's a little bit above the sort of 15.7 million that we've been averaging over the last 2 years. And the big question we have right now is the market shifting to a slightly higher gear because of increased lending and continued economic growth? Or are we going to start settling back into a lower level, back towards that 15.7 million or maybe below? because of this rising pessimism that we have out there. And that's what we're watching right now. Looking at where sales are year to date through the first 2 months, we're running about 1% higher than we were a year ago. So the vehicle market is showing growth, and that's sort of our baseline forecast, sort of in the low 16 million. But what's interesting is it's coming really from light trucks. They're up 2.4% year to date, and passenger cars continue to decline. They're down 5%. So there's still that shift of vehicles out there that's going on. But all of this combined suggests that the outlook for the vehicle market this year remains at about 16.3 million. That's what we figure the vehicle market will do this year if we're able to avoid this trade war. If President Trump goes full throttle and really implements all of these tariffs across the board on April 2nd, like he's talking about, it seems very likely that we're looking at a much smaller vehicle market because of higher prices, as well as probably a recession that's going to hit the broader economy to join that. So, like I said before, hope for the best, plan for the worst, but I think we got to figure that these tariffs are going to be here at least for a period of time. So, as the market's getting ready for that, these tariffs are actually coming at a time that's not so terrible when we're looking at inventory. This is coming from our vAuto data, and this is showing a summation of what is on dealer lots and in transit around the country, and in gray there. And you can see that overall inventory is very close to about 3 million units, and that's more or less close to the area that we were at prior to COVID. And so there's quite a bit of supply out there. And when we look at days of supply, which is that dark blue line there, it's running at about 94 days right now. Both of these total amount of supply and days of supply are up a little bit over where they were last year. But we're certainly well above the lean inventory period that we had back in 2021 and 2022. So the market knows it can get lean and mean out there. If inventory has to slow down and we do see production delays in the wake of these tariffs. So if it comes, it seems likely that right now, as we speak, these inventory numbers are likely building as manufacturers are really trying to pull ahead as much inventory as they possibly can to get it here on American ground before these tariffs kick in. But as I've said many times, these tariffs are going to impact these manufacturers differently because they're all in a very different situation out there. This is looking at days of supply for the major manufacturers. And you can see on the far right, we've got Jeep, Hyundai, Ford. They have days of supply well above the national average. It may be a bit of a silver lining for some manufacturers to have these tariffs, or if nothing else, they may be in a little bit more of an advantage because they've already got a bunch of inventory here that's not selling, or at least hasn't sold very well. And so they might be able to be a little bit more aggressive than some of their other counterparts. And you can see on the far left, we've got Toyota and Honda looking at very, very lean inventory levels. So they're not in a very good position. If these tariffs come in, it's going to start hitting their available inventory rather quickly because they just don't have as much lying around. On the whole, though, the impact of all these tariffs is likely to see incentives pull back. There's less of a need to really move the metal than we had before, particularly if these manufacturers believe that their production is likely to take a hit or there's disruptions, or they plan to pull back on manufacturing some vehicles in the wake of these tariffs. This is a chart that's looking at pricing out of the marketplace and price strength. And the dark blue line is showing incentives as a percent of the transaction price. And you can see that we hit a low substantially there in the summer of 2022. It's been rising in recent quarters, but where we stand today is at about 7.2%. That's the average incentive relative to the transaction price. And you can see it's fallen from where we were back at Christmas time. And this may be indicating some of the turn that we're expecting from some manufacturers as they pull back on their incentives to deal with this tariff crisis that's coming. The other thing we look at is the price strength, or what is the transaction price relative to the MSRP. That's what that green line is there. And you can see that during the peak lean inventory period in the summer of 2022, prices were about 102% of the MSRP. So The transaction price plus delivery was the price. There was very little negotiation to be had, but that price strength has been weakening, and it now stands at about 96%. That may change too as we get into this environment where inventory is going to become more valuable and there's going to be less motivation from the manufacturers to have those sales. Looking at the different brands out there and where they stand today, I pulled what is the incentive relative to the transaction price for the last 6 months for these different brands, just so we can get an idea of how their strategy is playing out in the marketplace today. And you can see it's quite varied. On the far left, we can see that Toyota and Chevrolet and Ford, at least through January. I don't have February numbers yet. They actually pulled back a little bit on incentives, and they still remain relatively in check in terms of how aggressive they're getting on their pricing. In contrast to what we're seeing from Nissan or even VW, where they're getting very aggressive with their incentives out there. All these strategies may change as each different brand is going to figure out what is their position in the market, how much inventory they have, and how these incentives are going to affect their own pricing. So overall, we can expect transaction prices in the marketplace to go higher and even more quickly. This is a chart that's showing the average monthly vehicle transaction price. And you can see in red where we are today. It remains quite elevated. We're near $50,000. It's down about 1% on a year-over-year basis when we look at our January numbers, but it still remains quite elevated. And the dotted line there is trying to illustrate what if we had just maintained the trend that we had prior to COVID? What if COVID had never happened? And you can see that prices today are a good, 12, 13% higher than where they should be today, at least according to sort of normal trends. And I think what we have to figure is once this tariff war or whatever we want to call it goes in full stead in April, we're going to see prices start to rise even more as manufacturers pull back on their discounting, and the vehicle prices themselves and the MSRPs have to rise to reflect the new costs of building these things. The other thing that's going to happen in the marketplace is on the used market. And we expect that the tighter inventory that's likely to come from these tariffs is going to have an impact on used vehicle prices. Just looking at where the used market stands today, sales are actually running a little bit above where they were last year. We're expecting vehicle sales in the used market to finish up somewhere in the neighborhood of about 1 to 2%. But as we enter into the spring selling season, which is right now, this is the hot season for the used vehicle market. This is when a lot of consumers are getting their tax rebate checks. We can see in the data that they run out and buy a used vehicle because now they've got the down payment for these things. And as we're entering into the spring selling season with the tariffs going on in the background, the used vehicle market is very, very tight. Available supply right now is a little over 2.2 million units. It's down about 2% from where we were last year. And days of supply, or how long the existing inventory will last based on the current sales pace, on the right there, you can see that's down about 9% from where we were at this point last year. So the vehicle market in terms of inventory is quite tight, just as demand is actually looking quite strong entering into the spring selling season. And all of this is going to have an impact on vehicle pricing. On the left here, this is the average list price that we can see from our vAuto data of what the average listing price is for a used vehicle in the market. And you can see it's about $25,300 in our most recent data point. But it's been falling over the last couple of years. When we had those lean inventory period, used prices rose dramatically, and it's been trending down. But that rate of decline is now starting to slow. And you can see on the right, this is the annual change in used vehicle prices. And you can see it's been under that dotted line for about 3 years now, or certainly a good 2 years, where prices have been falling on a consistent basis. But since last summer, they're falling not as much. And so that's that upward green line. We're starting to approach that used prices actually might cross that zero threshold relatively soon, and we might start to see used vehicle prices actually start to return to their normal upward growing trend. With the tariff situation going on, I would expect that that's going to move this needle even faster. If these tariffs go into place and they remain the value of vehicles in the U.S. market is going to go up, and that means used vehicle prices are going to go up. So lastly, I just want to talk a little bit about alternative opportunities. These are at risk. One of the things that President Trump has talked about is he's going to eliminate the Inflation Reduction Act. He's already said that he's going to back away from EPA mandates on fuel economy. That's actually probably a welcome thing in the industry, because those mandates were going to be tough to achieve. But backing away from the Inflation Reduction Act would be very detrimental, because that's that $7,500 battery electric credit. And that's been very helpful to doing vehicle sales. And that's what this chart is showing. This is a chart that's showing leasing share of retail sales. And you can see that when the Inflation Reduction Act passed in September of 2022, we can see that after that, the leasing of plug-in hybrids in purple and the leasing of battery electrics in green really started to take off. Manufacturers were leveraging that $7,500 credit as a capital cost reduction on leasing, so they're able to offer very, very low cost leasing offers to consumers, and folks have been gobbling it up, and that's really been helping to move the needle on sales. When we look at 2024's market, the total market was up about 2%, but ICE vehicles were actually down 1%, and where we saw growth was in the alternatives. Battery electrics were up 10%, traditional hybrids were up 29%, and plug-in hybrids up 18%. If President Trump backs away from the Inflation Reduction Act, that's dramatically going to impact those purple and green lines there. The leasing rates on those is going to fall back significantly. So all of this is a real threat to the marketplace. And the threat's going to be quite varied across the country, because we're at different stages in terms of EV adoption right now across the country. On the whole, looking at EV share of the market, well, in personal retail, it was about 9% of all sales were EVs last year. But it varies quite a bit by state. And you can see in dark blue here, these are the states that have a greater than 9% share of battery electric share of their total vehicle sales. Pretty much all across the West Coast and New Jersey and Maryland on the East Coast. And then you have a whole bunch of states in dark gray, where the battery electric penetration rate's anywhere from 4 to 9%. And then, of course, you have in light gray the locations across the country where penetration's below 4%. We can see it's quite varied across the country. So the impact of President Trump pulling back on these credits is going to be quite varied across the country and dramatic. But certainly it's going to hit the West Coast more than probably other parts of the country. And it's going to hit different manufacturers differently. This is a chart that's new I put together. I hope it's not too confusing. But I was trying to capture, if we think of the marketplace of these alternatives as their own marketplace. Battery electrics are about 8% of total sales in 2024. Hybrids were about 9% of total sales in 2024. Plug-ins about 2%, and ICE vehicles about 81%. Well, within these different product segments is these pie charts. And so we can see on the far left that within battery electric market, Tesla's 50% of all battery electric sales in 2024. Followed by a conglomeration of about a whole bunch of other manufacturers make up 25%. Hyundai is number 2 at 10%. If we see that $7,500 credit go away, we would expect that Tesla would probably suffer the most, at least of the impact to sales, but it would have an impact across the board against all battery manufacturers. If plug-in hybrids went away, you can see that that's going to impact Stellantis in purple the most. They have 43% of the plug-in hybrid market. And so they've been leveraging that for many, many low-cost Jeep leases. And so that $7,500 credit would be very detrimental if that went away. Where are those customers going to go? Well, if they're looking for fuel economy, they're probably going to go into the hybrid market, the traditional hybrids, the HEVs. And you can see that Toyota dominates that segment, followed by Honda. Combined, they account for about 76% of all hybrids sold. So they've got a whole bunch of products to offer for those customers if they decide to switch away, if that $7,500 credit goes away. And on the far right, you can see the ICE market. They may pick up some customers if folks decide to not go for fuel economy, but it's such a much more diverse market there in ICE. It's hard to say who's going to win or who's going to lose. But certainly the exposure to that $7,500 remains quite varied. But we still remain optimistic on battery electrics. Again, if the president decides to not pull back on that $7,500 credit, there's a lot of reason to remain optimistic that it could be another good year in 2025 for battery electrics. And really, the big reason being is there's going to be more products, many more new nameplates coming to market, and there's going to be more dealers. We got these products coming to some of the larger franchise manufacturers, and that combined means that we're going to get higher sales. Our own forecast is that we're going to see vehicle penetration in the neighborhood of around 10% battery electric this year, up from the 8% last year. But this is a chart that's just trying to show some of the nameplates, battery electric nameplates that are in market or coming to market. And I've highlighted a couple of important ones. You can see that for General Motors, they've got the Silverado EV coming to market. Very important to see whether consumers will gravitate towards a battery electric pickup truck. And we have the Blazer EV and the Equinox EV, a couple of mid-size and compact SUVs that are very, very popular in the gas version. The question is can consumers be converted over to buy the battery electric version? You can see that the Chevy Equinox in 2024 did about 29,000 battery electrics, but they did over 200,000 ICE versions of the Equinox. If they can convert some of those customers over, we may find that battery electrics can do quite well. A couple of other important battery electrics coming out this year. You've got the Ram 1500 Charger, another big electric pickup truck, only this one has an onboard generator. It's a new concept where you have sort of an onboard charger, and that may mitigate many of the range issues that a lot of folks have. I think that vehicle can go over 500 miles with the range extending capability. You've got the Kia EV9. That's going to be a 3-row SUV. Has potential to be very, very popular, and of course can take advantage of the huge distribution network that Kia offers and a lot of the sales success that they've had. And of course, Toyota has got their own BZ5X, which is essentially a Tesla Model Y fighter. That's going to be coming to market. And Tesla had the BZ4 last year. The BZ5 is supposed to come this year. It's going to be a bigger vehicle, maybe a little bit more of interest to consumers out there because it's got a little bit more space and can take advantage of Toyota's big distribution network. And of course, you've got Tesla with their own Model Y refresh. The Model Y had such a great introduction back in 2022 and 2023, quickly rising to be the best-selling luxury vehicle in the world. But its sales were down last year. And it may be a little bit long in the tooth. It may be that the competition got a little bit hotter. It may be that Elon Musk's comments have come home to roost and he's lost some customers. But this Model Y refresh is going to be very important because they need to move the needle. They need to see Model Y get back to positive sales growth for Tesla to maintain its EV dominance. The big question is will it have autonomous capability? I don't think we know for sure yet, but that's certainly one thing to keep an eye on. So a lot of reason to be optimistic over the near term, and I think there's reason to be optimistic over the long term. And one of the reasons that folks think that there is a strong future in battery electrics and why the industry has been pushed by the EPA and environmentalists towards this direction is because the thinking is that there's going to be great technology gains made in battery prices that are going to make these vehicles that much more affordable over the near-term horizon. And on an apples-to-apples comparison, I think one could make a strong argument that battery electrics are better than ICE vehicles. Certainly better for the environment, and I know that can be a loaded question, but as it's presented, it's better for the environment. Certainly for anyone who has a home charger and it's a second vehicle for them, I think it gets rave reviews. Certainly there's other applications that are less newsworthy. But when we look at forecasts for battery electrics, and this comes from Goldman Sachs, you can see that the outlook here from 2025 forward is that battery electric prices are going to continue to fall, that the cost of production of these batteries, the rare earth metals, the technology advancements, all of that is going to make battery prices to continue to fall, and they go down even further in the 2030 to 2040 timeframe. And all of this means that on an apples to apples basis, at some point, battery electrics are going to be more cost effective than their ICE counterparts. And that's when the industry really shifts over. We're certainly not there yet, but that's sort of the long-term view within the forecasting industry. The question is, do you mandate a switch to battery electrics, or do you just let the market do it itself? And one of the problems that we're dealing with is that for these battery electric prices to come down like this, it requires scale. It means that we've got to sell a certain number of battery electric vehicles so that the cost can be spread across all the significant vehicle manufacturing volume. And given the slow pace of development that we've had so far, we may not see that level of sales that's going to be necessary for prices to fall. So this is why we need this continued support. We need to keep this industry and this technology going. Otherwise, we're ceding a lot of ground to Chinese technology, and I think that could be very dangerous for the industry long term. So we just got to wait and see what the president decides on this, but hopefully he doesn't throw away the baby with the bathwater, because I still think these credits are a big positive for the industry. So those are my comments. If there's additional information that folks would like from Cox Automotive, I would just suggest to come to our Cox Automotive newsroom online. We post articles all the time about what's going on in the industry, as well as our auto market snapshot. There's a lot of resources up there to try and stay up to date with what Cox Automotive sees for the vehicle market. And those are my comments for this week.
Charlie, thanks so much for taking time out of your extra busy schedule this week to join us. We always love having you on, and it'll be interesting to see where we stand when we have you back next quarter. Again, you will all be receiving this presentation and recording by the end of this week. To those on the line, join us back here Tuesday, March 28th at 2 p.m. Eastern as Dealer Teamwork talks 5 game-changing digital marketing strategies that you'll want to hear. So be on the lookout for promotions. For more information about AIADA, visit aiada.org. Have a great day, everyone.